Hello everyone, Greg here from Master Trader. So let's go over the concept of a climactic sell setup. And I'm going to explain to you the details of what to look for here. And we're going to look at it in multiple time frames and put together a plan, if you will, on how to utilize this at the right time. So let's go over a few of the pointers as to what exactly we're looking for here. And I've chosen Berkshire Hathaway here, the Class B shares, because they have a few examples here that are going to be really helpful for us to review. Now, one of the things over here on the left side of the chart here is a good example. It's not a perfect one, but it's a good example of what we're looking for with a climactic setup. And one of the criteria is that we want to see multiple bars moving up in a fluid way. Right? So what does a fluid way mean? Well, what I mean by that is you're going to see the opening prices, and let's just review candles for a second. So you can color these candles any color you want, but red and green is most popular in what I use. So if the closing price is above the opening price, it's going to be a green candle and vice versa. So what I'm looking for with these fluid type of moves is the fact that the opening price, the new opening price, is in alignment with the old closing price. And it just continues to do that, straight up again. Now, this example, like I said, isn't exactly perfect because it has some tails there, but it's okay. It does tell us that buyers continue to step up on any dips. So topping tails within an upward move tell us that in smaller time frames, buyers are showing up and pushing prices higher. Now, the ideal scenario is like I'm drawing it here, where you get solid green bars that continue to float to the upside with the opening prices in the area of the closing price, and then the new bar closes above the open and it continues to push higher. Now, in this example, this is what we call, an exhaustion gap. And exhaustion gaps come, near the end of a move of multiple bars moving higher. And then, in addition, we had a wide range bar here. Right? Simply wide range bar, bullish wide range bar. So what does that tell us? Well, in the essence of this is traders are buying this, investors are buying this, and it's continuing to push higher. And then even on the gap, they jump on there with the intent that, this is still a great buy, even though it's already moved up from a level here, which was the perfect buying setup. This move up in this beautiful little downward sloping consolidation at resistance. That's what I call absorbing supply here. With this type of pattern, it's very bullish. And then your entry point here, and then of course the gap telling us that this is probably the end of the move, and then you got to go into your management strategies and how you're going to exit this. The wide range bar, in this type of wide range bar, typically is going to mark a high of the move or near the high of the move. So at that point, we like this as a setup here for a climactic sell setup, and then we wait for a reversal, like this red bar right here, and then it's got to trade under the low. Sometimes you're going to get a retest pattern. You don't know how it's going to set up each and every time, but we have the initial criteria in place to play that. Now over here on the right side of the chart, we see the same thing happening again. Whereas, you had this bottoming type of pattern here, the gap up, and here we have a different type of bullish setup here, meaning you have a gap up and then a little sideways consolidation with the bottoming tail bars. Again, buyers are stepping up on the dip, and then it pushes to the upside there. So what we would want to do now is go to a higher time frame and see, is this extended on a higher time frame? And when we've got a wide range bar here, it's really not that extended because it had this decline here and then this consolidation, and now it's pushed up above this resistance area. So in this setup here, on a short-term basis, this would be a climactic sell. And how would I utilize this? Well, I wouldn't want to short this. based on this time frame. However, what I would look for, this is somewhat similar to what's happening right now in the Dow Jones average right now, one of the only ones that are moving higher, but it's multiple days moving up. But the hourly is still moving to the upside. So even though this is, you candlestick aficionados would recognize this as a hangman, and then you're looking for it to break below here. But so we would say maybe that's the end of this move short term, but the trend is still up on the hourly, so let's wait for this to break, and then maybe as an intraday trader, we might have a setup there to trade accordingly. Now, what to do over here, right? What we would do here, so like you own this and you don't want to sell it, but it's not really so pleasant to be sitting through a pullback of this degree. What could you do? Well, you can buy put options as a protective strategy, or at these times you can sell what's called a covered call. So you can sell an option. You would take in that premium, goes right in your bank account, and you're giving someone the option to buy or take this actually from you at a higher price. So now you would pick a higher price, and this is what we do every day in our advisory letter. We'd say, okay, here's a pattern here that suggests this is not going higher, and we would pick a price point up above here where it's very unlikely to go, and sell those options against a long position. And we might consider this here, but we need a little bit more of a price pattern to even consider that. But let's look at a few other patterns here. Let's look at Citibank. This has been one of my favorites for a little while. Financial sector, it's been on the move here. And recognize this pattern here because it's a similar pattern to what I showed you before. Very bullish pattern with a downward sloping angle toward the 20 MA here after the breakout. Now there's no resistance over here that we can see on the chart, but recognize the pattern. Very bullish pattern, downward sloping after a breakout, and then here it got going again. And something similar here, where it pushed down below the 20, and that is actually just fine because of the extent that it moved up. The 20 is just a guide. It's not real support. It's just a reference point, a visual aid as we call it. So looking at this, as we looked at Berkshire, there's nothing here to suggest a climactic pattern. We would want to sell calls or buy protective puts. This is moving up in a way where investors and traders are just, okay, it's gone up. Let me sell, get out of this. Kind of like climbing the wall of worry as it goes. So let's look at a higher time frame. And so here we have something similar to that pattern of bars moving up in a fluid way, and then the pullback and the retest and a nice consolidation here and a continued move up. So this still looks good. No climactic patterns. It should continue to go higher. Everything is moving along as prices normally would in a stock that is not become climactic yet. In other words, investors, institutions are not falling over themselves trying to buy Citibank here, but it's still being accumulated. And, we could go to the monthly chart, but it's really skewed by the huge decline that it had years ago and the reverse split that it actually had. But as I move this along, you can see there's a huge amount of room for this to potentially advance here and at some point become climactic, where we probably wouldn't want to sell this. I wouldn't, because I think it has a lot of potential, but there will come a time where I may want to sell a covered call against a position when it creates a pattern that suggests to me that it's likely to begin to pull back or go sideways for a longer period of time. And we can take in that premium and put that money in our pocket, lower our cost. And the downside of that is if we're wrong, and in this case, Citi continues to push higher into expiration, the stock will be taken away because you have sold the right to someone to do that. All right, so let's look at a few others here. Facebook is extremely popular stock, and we're looking at the daily time frame right now. You can see right here the daily time frame, and while it's a little extended here from the 20, more so because of a gap, not a fluid move. Right, so the move started to become fluid, but it was coming out of a base. Right? And now here was the second part of that move in the gap, and now it's beginning to correct that and consolidate, but so far things look, well, okay. Let's go to the weekly time frame. A little bit more of that fluid move, but it's only 3 weeks. And so how many weeks does it take? Well, it's kind of hard to say because it changes with different stocks and different market environments. But when it starts to get extended from the 20, and then as you begin to accelerate, usually it's going to be 5, 6, 7, maybe 8. I'm going to show you a perfect example in a minute here of one that's set up right now. So again, this is another stock that probably you wouldn't want to sell on a long-term basis, but when it gets extended, that climactic pattern, it will make sense to sell a covered call or maybe even a protective put at that time. Now, the weekly, a wide range bar, but it's after a little bit of a consolidation here. So again, not the ideal type of pattern for looking to, selling a covered call or buying a put. Now, buying a put, you're always, that's your insurance. So what are you going to lose? Basically, the cost of the option. No one's going to take your stock away. Even in a scenario as we have right now, and this would not be a pattern that I would be selling a put on since it's pulled back into the gap fill here. You usually want to do that after it's already accelerated or possibly you've missed the turning point or a breakdown and you want to protect yourself. But right now, Facebook looks okay. It's pulled back here after the gap, and we've got a little reversal here after a bottoming tail bar, and we'll see what this can get going here again. Now, PayPal is interesting here. We'll have to go out to a weekly time frame. And this has begun to accelerate here. And I'll actually show you that the momentum has begun to slow down. Now, this came out of a base. Here's a wide range bar igniting. Fantastic pattern, especially on a weekly time frame, a consolidation and a wide range bar igniting. And you had this move higher here, and now a little bit of another move, a little less momentum. We've got a topping tail on the weekly. And this is one where I would be tempted to sell a covered call. It's not that much of a fluid move, but it's had a second run. It's extended, and we've got a topping tail here. So if I could find an option up above this level here where it would make sense. So here's the concept of selling a covered call, as I explained, away from the pattern. But does it make sense? Are you going to get enough premium that it makes sense to do it? So when you look at your options table and you look at it, let's just say, for example, a 65 call, you'd say, well, if I could sell that 65 call for whatever the price might be at the time and put that in my pocket, what are the odds of that option expiring worthless in a week? I think we'd all agree, well, that's a no-brainer. I'll do that any day of the week. This isn't likely, especially after it's already reported earnings going to $65 in a week. But odds are that option isn't going to be worth very much. It might not even be worth the cost of commission to do it. Well, what if it's a month out? Well, you're going to get more money because of the time decay and the time value there. Maybe it would be worth it. What about 6 months? Well, I wouldn't be willing to do that. Why? Well, because PayPal looks pretty good, and I think in 6 months it could easily, within that time, go up to that level. So I would not be willing to do that. So we have patterns to consider, and we have the options, pricing, and time to consider as well. Ameritrade I noticed this one, and here we have that fluid type of move and a wide range bar, and then as it broke under these lows, that would have been a perfect pattern. We'd probably be selling a bearish call spread above this level here. And that would allow us to take in some money with a protective stop up there, and we'd be able to keep that money, the difference between those spreads, and we do that a lot. And here is an example, and this isn't a climactic example, but this is an example of where we would want to sell a bullish put spread down here. So, and as this is come up into this area here, it is an interesting spot to consider selling a covered call if you owned Ameritrade, since it's a retest pattern. And we do have a bit of a fluid move. It's really not extremely extended since it came out of a base, but it's retesting this high here. So it is interesting, a possibility. And the daily here is still in an uptrend. It's pulled back actually to a point where it might be able to turn back up again since it's into the gap fill. All right, we get a little long here in this video, but let's look at what I would consider a perfect scenario. It's definitely not a stock I would want to sell if I owned it, but it has become climactic. And you're saying, well, Greg, that doesn't look climactic based on what you said earlier in the video, since it's not extended from the 20. It's not a fluid move up. It's a consolidation here. But let's look at the monthly time frame. Now you've got a fluid move up. The ranges began to expand, then contract. We've got a topping tail bar here. So now the question is, can I find a call option to sell that's out of the money that makes sense within a particular time period that makes sense for me? Because based on this monthly chart, it certainly looks like McDonald's is going to pull back or at least go sideways for a period of time. And that's the beauty part about options. It doesn't even have to go down like it would have to if you shorted the stock to make money. So let's just say, for example, I could sell the $170 call that expires in 2 months. If this McDonald's just stayed sideways in this area, I get to keep the money. And over the course of those 2 months, that option is going to become worth less and less and less because of the time decay. So it's a beautiful thing if you know how to combine price patterns with option strategies, and we do that in a big way and in our Master Trader advisory service, which you can see here if you're coming to the site at mastertrader.com, and go and click on the advisory service, and you can read about the letter. You can see a sample letter, and one of the things that we do in the letter is market timing with market internals for an intermediate term basis to time some of our trades with market timing, and we review sectors of interest, the broader markets, and we update intraday videos like this. And by the way, we have a service coming out. If you like this type of a lesson, we're going to a service called our weekly lessons, and there's going to be a lesson similar to this that comes out every single week as part of that service. So you can subscribe to our advisory service for an extremely low amount. So come to the site, check it out, and join us, and you'll learn a tremendous amount, and we'll show you how to use options and price patterns to make money on a consistent basis.